Okay, let's get started. We have with us on our panel today
Cherie Proctor with NACA.
Moses Henry with Regions.
Teresa Warren with Fifth Third Bank.
Okay, with such a group of experienced and knowledgeable experts, we'll start with some general questions and then we'll work down to the specifics. Earlier this week, Wall Street Journal front page caught my attention, especially since we were having this panel today. It says U.S. banks back off tight mortgage rules. And it says that on Tuesday, Mel Watt, newly installed overseer of Fannie Mae Freddie Mac, said the mortgage giants should direct their focus toward making more credit available to homeowners. Further down it says those rules largely abandon earlier proposals requiring large down payments on mortgages, on certain types of mortgage-backed securities, and that begs the general question, are mortgage loans really available right now as it appears, or what's different than it has been over the past few years as we've come out of a recessionary period?
I read that article. It has, I just remember a couple years ago, it was, they tightened because we went through a big foreclosure debacle. And now what I'm seeing and just listening to, because I learned some stuff here today too, some of the products that SunTrust has and some of the products that Wells Fargo have and some of the products that Regions are with NACA. And what you're seeing now is these organizations coming up with additional products because there are loosening some of the requirements on some of the loans. Like Fifth Third, we just started, we had a minimum credit score on VA loans. Now there's no minimum credit score. I just closed a loan the other day with a lady with a 580. So we are loosening some of those restrictions, and a lot of the mortgage are Fannie Mae and Freddie Mac. Before, you had a lot of investors purchasing mortgages, and now you're starting to see the market kind of calming down a little bit, and you're starting to see more of the lenders offering these 100% loans on mortgages, and more so offering a lot of products to first-time home buyers and a lot of home buyers with some types of challenges.
You have had a lot of loosening up of some of the products that she mentioned. The one area that I will say is pretty much still kind of tight is for people who are self-employed. Now, I don't know if anybody in here fits in that arena, but if you're self-employed and you're writing off a substantial amount of your income, that can affect you somewhat negatively, because one of the biggest things that I think all of the lenders have had to deal with has been the ability to repay. They want to make sure that you're able to pay back the loan, that to prevent foreclosure. So foreclosures caused a lot of this stuff to come about, and the system really tightened up. And even though, like she mentioned, VA and FHA may not have really had credit scores, but what you had was lenders that were placing their own limitations on top of that, like we want a 620. I've heard some lenders say, well, we'll do VA or we'll do an FHA loan with a 620 credit score. Really, it doesn't take that. We could do it with a 580. However, they want to make sure that you have enough income to support the debt. So that's the biggest thing. And what I'm finding here, that's still kind of the last thing to kind of come along is for example, for people who are self-employed. It's really, really tough. If you're self-employed and you write off all of your income, then it makes it seem like you can't afford anything. So what I try to caution people, if you're self-employed, you can not expense off everything, and you might end up paying more income tax, but at least you'll be able to qualify for some things that you may want to take advantage of.
With the NACA program, it's a little bit different from the two lenders here on the stage. I really don't want to get into my requirements because I don't want to stray away from the two here. However, we do work well with self-employed buyers. Reason being, we use a cash analysis, meaning their 12 months of bank statements, rather than their tax returns to determine the income. The only problem that I've noticed over the years is that a lot of individuals don't deposit every dime that they make. Normally, if it's a cash flow, they're using the cash rather than depositing, and I always indicate to them, let's deposit the funds, even if you have to turn around and withdraw it, but just let me see that you have the ability, to earn that income, and I'm able to track it via your bank statements rather than your tax returns. I totally agree that the lending products are becoming more, I guess everyone is able to take advantage of the products normally, because before they weren't able to, and you're right, we had a limitation on the credit score. My only concern is that these individuals are being educated on home ownership. Because you can go out and give an individual a loan with a 580 credit score, but if they don't really understand why they're getting it and how they should maintain it and those type things, it's null and void, because later on down the line they're going to come back to these lenders and say, hey, you know what, I can't afford to pay my mortgage anymore. What have I done? What we do is that we try to make sure, or we educate individuals whether they are obtaining a loan through our program or any other product out there that's available. So that's very important. As far as, let's see, what else did we talk about?
Here's where we'll go with that, because there are several topics that have been covered in those, and so we're going to break it down and go and hit some of those. One of those, since we talked about home buyer education, which impacts a lot of things, and the other thing that kind of goes hand in hand with that is delinquency and foreclosure. And so we'll deal with several pieces of that. But let's talk a little bit about the home buyer education process, since you touched on that. Because people frequently want to know, why do I have to sit in an 8-hour class? I want to buy a house. That's what I want to know. So let's talk about some of the relationships, and I'll kind of tee it off with, we know that statistically you're much less likely as a first-time home buyer to experience delinquency or foreclosure if you've gone through a proper home buyer education and preparation process, which involves understanding the budgeting, which involves not just how do I get approved, but how do I get myself in a situation so that I can stay into the house. And so that's what should be happening. Let's build on that and talk about some of the things that you look for and expect, and some of the differences between going through the process and being prepared and not being prepared.
Okay, I'll touch on that first, and then what we do during our home buyer workshops is that we go over extensive budgeting. I will give an individual a daily expense diary as well as a monthly diary. And I make it kind of comical for them, because I want them to not just indicate on the sheet of paper what I think they should put on this paper. I always tell them your budget should be a reflection of your bank account. If I see that you have $1,000 left over on your budget, and then I look at your bank account and we're running $12.56 a month, then I know that there's an issue. Something is not right. So we'll go through and totally look at their expenses and their debts and things like that to determine where's the breakdown, where can we save, where can we do this. And a lot of times I can only paint a clear picture for an individual, but it's totally up to you to determine whether or not you want to move forward with that. And a lot of times it's a choice between cable and saving, or some things that really aren't necessities. We totally go through that with a member. We also help them as far as determining what's important in their lives. I have individuals right now that may qualify for, let's say, $70,000. However, they're looking at $200,000 homes. And I hate to disappoint them, but the reality of it is we need to, and I always tell them, let's stay in your lane over here, and let me show you how to get to that point. So we try to I call it the roadmap to home ownership. And it's totally up to them to follow that. I'll let you.
Yes, and while she's passing the mic, let me just, for those of you who are going through the process, we typically ask how many people has a budget, okay, and how many people have it written down. One of the reasons why the budget has two versions is because everybody's first budget is a lie. Okay, everybody's first budget says, I got this money left over that you never had left over before. So that's where the work comes in, working with your counselor to go in and flesh out reality versus that imaginary first round you put on paper, because everybody's first round is a lie, and then you go work on the real budget. Pardon the interruption.
No, you were absolutely right. Hey, that's probably one of the first steps that I do when I sit down and talk with someone. First thing I'm going to do is we're going to get to the point where we're going to access credit. Okay, and the reason why we're doing that, in addition to looking at the scores, we're looking at the debt that's hitting the credit bureaus. One of the biggest terms that you're going to hear when getting a mortgage is called the DTI, and that's standing for debt to income ratio. Okay, so it's going to look at your total income, the gross, okay, from your paycheck, and it's going to look at your debt. The minimum monthly payments, if you have a car loan, if you have a credit card, it's going to look at that minimum payment that's hitting the credit bureau, and it's going to compare that against your overall income. And when you take into consideration the new payment from a new home, you want to look at, generally speaking, and I'm being a little bit conservative, somewhere in the neighborhood of 40%. Okay, if the new payment and all of the other debt is usually at 40% or less, then you're pretty much good to go. But the overall thing is looking at that debt to income ratio, because, like she mentioned, there are a lot of people that come in with unrealistic expectations as to how much home they can get when the income doesn't support it. So, and that's not to say that they don't have it. It's just to say that they don't have a paper trail that's clearly defining how they're making their money. And let's face it, there are people out there who for example, barbers or beauticians, a great amount of their income is cash, and they're not running it through the bank, so there's no real paper trail, even though they're obviously able to pay $1,400 for rent, and they have a card that's showing that their income is at a certain level. But when you don't have the paper trail to support it, then it's really, you're kind of spinning wheels for naught.
Allow me to translate that to English. What we're talking about here is people walk in and they'll say, well, my tax return don't show all of my income. I don't show the IRS all of my income. Well, as a lender who's getting ready to lend you some money, and you're telling me you're lying to the IRS, but you're not going to lie to me, that's a little bit problematic. So we need to reconcile our representation of what our cash flow is. And the debt to income, that's a ratio comparing your debts, monthly debts, and your income. Now, if you want that comparison to change, there's only two things you can address, right? You're going to address your level of debt, or you're going to address your level of income, or you're going to address both. If your comparison of your debts to your income says this is how much room I have left for payment, and nothing else creates more room, that's what you can afford. That's not always what people want. What they can afford is, that ain't me, no child, that ain't me. Okay, that's where the problem starts. She talked about differentiating between needs and wants. We talk about a lot about two things in home buyer preparation a lot: budget and behavior. Because most of our credit and debt issues are not financial issues, they are behavioral issues. And the behavior is the failure to differentiate between needs and wants. And simple definition of needs: they sustain life. Air, water, food. List short after that. If you got a hoopty and it gets you to work, you don't need a car, you want a car. Your basic need is transportation to get to where you need to go. Okay? Pardon that interruption. Carry on.
Okay, and I think the question that I heard you ask originally is, and I hear this a lot, we tell the customer you got to go to the 8-hour home buyer class, and they look and say, 8 hours? And let me tell you why that is so important. We are all sitting up here, and yeah, we can probably get you in a home, but the most important thing is sustainability. We want to keep you there, right? And that first-time home buyer, and I'm telling you, I do some classes with Habijacks. I'm sitting here, I'm listening to some of the other lenders, because it's really nice when you get lenders where we may not have the product, but we have resources. We got other people that can fit that need, because everybody's need is different. I learned something with JEA today, sustainability. I hate getting that high $300 a month electric bill. And that's why we want you to go to the first-time home buyers class. I've been to a first-time home buyers class probably 300 times, and I feel like I'm there for the first time every single time, because I'm learning something about myself and how I can cut my bills. We just don't want to give money away. So when you're coming to us and say, man, I got to go to that class 8 hours on Saturday, if that's a problem for you, then you really don't want to be a homeowner. Because I'm going to tell you guys, nothing is worse when you I'm going to be a homeowner, and you tell your friends I'm going to be a homeowner, and you're excited about it, and you're inviting everybody over, and 2 years later, you're not in that home anymore. That can deflate an ego. So we want to make sure that you get that home and that you keep that home. And I teach these classes because we have to do what is called CRA, Community Reinvestments, part-time. And I teach these classes at Habijacks, and they got me in this coaching program. I got 4 ladies that I'm coaching. And I've done something different that nobody has done at Habijacks. When they told me to coach these 4 ladies, I went to their homes because I wanted to meet their kids. Some of you got credit challenges. And if your kids don't buy into this process, it's going to be very difficult for you, because there are things that we will do for our kids that we will not do for ourselves. When they want those Nikes and you tell them, no, I can't buy those Nikes because we're trying to get a home. You in that one room with your 2 other brothers and sisters. Don't you want to have your own home? So we want to make sure that we not only counsel you, your kids got to buy into it, because then they got to know why they're not going to McDonald's 3 and 4 times a week, why they can't get those Nikes, why they got to go and help you guys maybe mow some lawns in the community, bring a couple of dollars in, not to help you pay bills, but to pay the things that they want to do. That's why we want you to go to the 8-hour class. Because we want you to stay in the home. Teach one, right? Knowledge is power.
Hey. All right. And now everybody wants to go to class, right? But it's vitally important, because, and we do a lot of work on the back end with delinquent homebuyer counseling. And we say all the time, if you are our homebuyer education client, we're not likely to see you as a delinquent mortgage client, okay? And when we talk to people who've gotten into the situations that she's talked about because you don't have the patience, again, it's back to the behaviors. Changing adult behavior is difficult. Getting rid of my habits, difficult, okay? But to get to where we say we want to go, either you're going to make the changes and be on the way, or you're not. Like Teresa said, it's your decision. But we know for a fact that if you don't get the preparation, what happens is you end up being a renter with a mortgage. And that's a bad situation. Okay? We hit on a couple points in there that I want to build on, and get to some additional stuff that people are interested in. And we talked about running into difficulty. We talked about foreclosure, and we talked about recovery. So I want to start with kind of the credit requirements to get into a home, and then we'll move into where you have difficulty and some of the other detailed questions. But first of all, let's talk about the definition of a first-time home buyer for people who are in recovery. And the definition of a first-time home buyer is if you have not had an ownership interest in a home in the prior 3 years, you are a first-time home buyer by definition. So if you had a home 5 years ago, you haven't had a home within those 5 years ago, you qualify as a first-time home buyer for the definition of the mortgage and application process, okay? So as we talk about credit for those first-time home buyers or recovering buyers, let's start with the issue of recovery. Okay, I've been to hell and back, I've had a foreclosure, I've had all this stuff, and I'm on my way back, all right? Where do I start, and what do I do, and what do you tell me relative to someone who hasn't had those experiences? Well, everyone will get a chance to talk.
Okay.
Okay,
No
so
problem.
we'll start with the NACA process, which is different than the traditional lenders, and then we'll move and we'll all get informed, all right?
I totally feel like an outsider.
Hey, well, you're at home today. There's a reason you're here, and you're a different flavor than the traditional banks. But all of our constituents don't come in one flavor. People come with different sets of experiences, and so you're not a fish out of water. You're swimming with us.
Thank you for the opportunity again. With our NACA product, if you've experienced a foreclosure, short sale, bankruptcy, we will need 2 years after that. I'm not sure what the lenders require. However, the NACA product is 2 years. Now, as far as our definition of a first-time home buyer, our definition is as long as you don't currently have ownership interest in a property. So if you sold your home yesterday, you can qualify tomorrow. That's our definition. Now, as far as road to recovery, if you've experienced a foreclosure, short sale, or bankruptcy, what I would like to see is that you've maintained current rental payments. That is the most important thing to me because I can determine how you're probably going to pay your mortgage.
How do I prove my rent is current?
I'm sorry?
How do I prove my rent is current? I pay my rent all the time.
Okay. Well, first of all, I'm going to contact the landlord and request a verification of your rental payments. If the landlord is unwilling to provide that information, then I'm going to come to you to say, hey, can you give me 12 months of your canceled rental checks? Now, I've heard a lot of individuals who indicate that they pay their rent by cash. That's not a good thing. Reason being, how can I track the cash payments? Now, I have had individuals who would withdraw the exact amount of funds the same time every month. That's okay too. However, if I turn around and I ask the landlord just for verification, they may say, and I've had this instance, say, well, you know what, I found every rental payment but November. I went back to the buyer. Hi, show me that November bank statement where you withdrew the funds. Although I can't verify with the landlord that he received the cash payments, but I can kind of tell if it was the same time, she could not. So I had to wait 12 months from that November payment until the next November, which is this November, before she's ready to qualify, because I must see 12 months of on-time monthly rental payments. I must see 12 months of current debts. As far as, say, for instance, if you have a JCPenney's or Sears or an auto payment, if you've had a late payment within the last 12 months and it was within your control, then we're going to need to wait 12 months from the date of that last monthly payment. Now, if you come to me and say, you know what, Cherie, I've had some medical debts, I've had some things that happened to me in my life, and I've had a couple late payments, then that's a loan that I'm going to fight for, because NACA, we stand behind whatever makes sense. I don't want to put a person in a home that has habitual late payments here and there, but if I know if something happened in your life, that's why you have to be open and honest with us so that we can help you along the way. I don't want to turn anyone away, and actually since I've been with NACA December of 2008, I have never turned anyone away. It just may have not been their time to buy at that time. I have individuals that were qualified in 2 weeks, and I have individuals that are still with me from December of 2008. So it is a process. It's a very tedious process, and as he mentioned, the road to recovery, sometimes it appears to be very hard and difficult, but we are there to assist you along the way. It just takes patience and the willingness to do that.
Okay. And I think a lot of our things are pretty much consistent with what she just indicated for NACA. But when I look at significant events that have occurred, such as foreclosures, bankruptcies, generally it is 2 years. Now, keep in mind that everything is kind of program specific, so I know that there are some rare instances where they're like a 4-year situation. And I think it's distinguishing between the different types of bankruptcies, be it a 13 or a Chapter 13 versus a Chapter 7. So I know that there are some differences there with different programs. But for the most part, when you have a significant credit event, it generally is 2 years. So for the most part, that's kind of what we're looking for. I don't know what else to say on that one.
Okay. I think we're kind of mimicking the same thing. It's just a matter of, how bad do you want it? And are you willing to get started on the road to recovery? Like she said, some people it takes 2 weeks. She has somebody that's been in the system since 2008. Our products are governed by our investors. So you may go to a bank and say, why? Sometimes, most of the times their hands are tied. We have to go by FHA. I'm sure you guys heard of that term, which is synonymous with HUD. We have to go by their guidelines, because once we complete that loan and you close, that loan, the investor of that loan is FHA. So in order for FHA to purchase that loan, we have to go by their guidelines. Now, some of the lenders do have what you call overlays, which I've seen a lot of the overlays get canceled since, we're doing a lot of lending. But for the most part...
I ride the short bus. What's an overlay?
And an overlay is when we talk about these institutions that purchase these loans, these investors, they have guidelines. So these are their guidelines. These are the floor guidelines. Well, you may have different lenders that say, okay, I know FHA says there's no minimum credit score, right? But my credit score for my institution may be set at 620. Some other lenders' institutions, the minimum credit score is 580. So that's an overlay. Those are things that are a tad bit different from what the investor says they are allowed to do. And we a lot of times the lenders will set those overlays based on historical data.
A quick interruption so that everybody understands. He talks about investors so that we're very clear. The majority of the mortgage loans is not the lender's money. The lender gets money from an investor in China, from an investor in Dubai, from investors on Wall Street, and that money passes through the lenders and it's loaned to you. And those investors buy that loan, the lender makes a little bit, and the investor is who you really owe the money to over the life of that loan.
Yeah, let me just piggyback off of that. What happens is you look at a financial institution. For example, say this month the financial institution did $1 billion in loans. So now here's the financial institution has this bank account with $1 billion, and we just closed $1 billion worth of loans in April. Well, in order for us to do more loans, we got to put more money back in our bank account, because now we have to replenish that bank account. So what we do and what the financial institutions do is we sell those loans in the secondary market, which is Wall Street. That's your FHA, your Fannie Mae, your Freddie Mac. So we can have more money. We're replenishing that account so we can do what? We can have more loans. And so what happens is, you ever had a loan and you closed a loan and you thought Wells Fargo was your lender, and now you get a letter from somebody else, from Fifth Third, now Fifth Third has the loan? Well, it's really called who's going to service the loan. So we service about 95% of our loans, so you see that transparency. You think that we have the loan when actually we don't. It's sold to FHA, it's sold to Fannie Mae, Freddie Mac, Ginnie Mae, but you see that kind of that seamless transition where you think Fifth Third has your loan because that's who you're paying your money to. That's when you call customer service to, but it's not far-fetched for the lending institutions to sell your loan, okay?
Okay, I wanted to kind of touch back on that, those significant events such as foreclosures, repossessions,
Death in the
bankruptcy.
family, divorce, disability, sickness, illness.
Right. I get a lot of folks that come into my office, I would say weekly, who have gone out to some of these, I call them scam artists, really the credit repair people that are taking them for a ride and their scores are really not. So if that occurs, please make sure you get with somebody reputable, do your research, do your homework, get with somebody that's going to help you, not take hundreds or if not thousands of dollars from you and do nothing, because I've seen it happen too many times, and it's like they're preying on people. And it's becoming a real bad situation out here.
All right, so keep the mic. You just hit on an area that we touched on a little bit for those of us who are recovering credit-holics, which is America. Our economy is built on debt. And since we talked about recovery, foreclosure is one example of recovery. Bankruptcy is another example of recovery. Or I just woke up one day and somebody told me I had a 520 score and that's way below what I need to have to get to where I need to go. So if I walked into you today, my name is Bubba, where do I start? Because my credit is not right, I already know it. Where do I start? What do I do?
Well, here again, that's not necessarily my area of expertise, so I tend not to. I tend to refer them to people who I know that will take great care of them, and not just take them for a ride. So what they are in need of is somebody that's going to sit down with them, go over the budgets, do credit counseling as opposed to trying to do a quick credit repair job on them. And like I said, I've seen it a lot where they get taken for a ride, and a lot of times their credit scores don't go up as a result of it.
Okay, before Teresa starts, because she's going to give you a very informed answer, let's get back to an emphasis though, where we talk about what fundamentally credit is, what fundamentally your credit report is, because your credit report isn't some magic thing to manipulate. A credit report is a snapshot, a picture of what you look like, what your past bill paying behavior has been, and you know what your behavior has been better than anyone else. So there are no magic wands to make you look like you're someone else, okay? So that's not what we're talking about here. We're talking about how to fundamentally get from where I am to where I need to go. If your behavior is not going to change, your credit profile is not going to change, okay? So now that we know we're talking about fundamentally making some changes to get to where I got to go, we'll let Teresa tell us how she would help someone get there.
Yeah, I do. Yeah, certain ones. Credit. And sometimes we get challenged, and what we're really talking about here is how do I repair my credit? I know my credit is not good. I'm ready to buy a home, because let's grant it, people don't tackle the credit to go buy a car, because chances are no matter where your credit score is, you can get a car loan somewhere, buy here, pay here facilities. Most people will tackle that mountain when they want to purchase a home. And this is, and he talked about these organizations, these credit repairs. I can pull a credit report and I can tell you in a matter of seconds whether you've been to a credit repair. Because what the credit repairs do a lot of times is disputes. And if I'm pulling a credit report, and let me tell you about disputes, guys. Your credit is your integrity. Let me say it again. Your credit is your integrity.
That's what my mama said, and I figured she didn't know what she was talking about.
And that is so very important. So, and I'm looking, and now I'm talking not from a loan officer's point of view, but from a underwriter's point of view. Because people will get angry and thinking, and let me just be real, because that's what we're here being real for, is a lot of times we will send in a application, and sometimes when we are minorities, we think they are discriminating, because that has happened, right? But the underwriter, all the underwriter gets to see is what's on paper. We get to know you. So we got to basically take that paper, and we got to take that paper, and it has to come alive so we can get the underwriter to get to know you. But if I'm getting a credit report and I tell a customer, what are you disputing? A $3,000 credit card bill, what are you disputing? Did you make the charges? Yes, Miss Warren, I made the charges. So what are you disputing? That's integrity. So what happens when your credit and your file goes to the underwriter, and she's trying to make a decision on whether she's going to approve you or decline you, and she's right on that borderline, right? Now integrity comes into play more than anything. And she's looking at a dispute, and she's calling me, Teresa, what's up with this dispute? So what we need, and I'm saying that to you because sometimes people get disenfranchised because they don't want to put in the work. And we are asking you to do that so it will increase your chances of what? Getting a loan, because that's what it's all about. Because remember, guys, when you buy a home, although you're getting these programs, down payment assistance and all of these programs, you got to pay for, chances are, application fee up front. You may get it reimbursed at closing. You got to pay for inspection. You got to pay for an appraisal. There are some investments that you have to make up front. And I don't know if you're anything like me. I have minimal resources. So I don't want to spend all my money unless I know I'm going to get that loan. So when you go to these credit repair places, and I had a conversation with somebody in the audience, they approached her and she said, no way. Because we're going to repair the credit based on the loan we're going to put you in, because all of the different loans have various guidelines. So what we're going to do as lenders, we're going to look at that credit score, and we know you got minimum resources. So what we're going to do is take those minimum resources you have, and where they're going to have the greatest impact on your credit, some of the things you're going to pay off, where we're going to get those scores up for you. And just remember, we're looking at the credit score. We're looking at what's on the credit report based on your debt to income ratio. But I always tell the client, there are a lot of things that is not on this credit report that you have to pay. Child care, light bill, getting your hair done, some things we just can't do without. So my first question to you is, what are you comfortable with? Okay?
Now again, with the NACA program, there's no minimum credit score. Actually, my first, and we call the customers members because we want to make you feel as though you're a member of our family. So my first individual, his credit score was 420. Now, me coming from Regions Bank.
Was he breathing?
Yes, he was breathing. Me being a lender at Regions Bank for years, when I became employed with NACA and I saw this credit score and I looked at the requirements and I said, I don't understand how this is going to work. Now, he was my first member, and when I saw his credit report, I said, now what in the world can I tell this man to encourage him, and then also to get him approved, because that was my sole goal, to get him approved. So I looked at the guidelines, and the guidelines says, we are only concerned with what has happened to you within the last 24 months of your life. We're only concerned with any active debt that has been paid on time for the last 12 months. So with those requirements, I was able to give him what's called a task list. And that is just clear indication of all those things that he needs to repair prior to qualification. Believe it or not, within 6 months, this man completed this entire task list. When he left the office, I had him so pumped up. Now, mind you, I'm thinking in my mind, I'm probably never, ever going to see him again. But I encouraged him so much that this man went out, and what I didn't realize was that he was a single parent. I really didn't pay a whole lot of attention to it because I was so focused on the credit, because I was in his place wherein if you really didn't have the scores, then I probably didn't spend a whole lot of time with you. But now I'm in this program where I'm going to spend a lot of time with you to get you to the finish line. So I gave him this task list. He calls me, he says, "Miss Proctor, I'm done." I said, "Really?" So I said, "Come on back in." And I didn't realize he was a single parent. He'd taken his entire income tax check, paid off the things that I've asked him to pay, and then he had saved his money for the prepaids. That was just the highlight of my career ever. Out of my 18 years, that was it. Just in every day that I think about it, it brings a tear to my eye, because had you seen this man when he received his key, and he ran shouting and all up and down the hallway, and guess who was behind him? Me. I was shouting along with him because that was an accomplishment for me. I felt as if that was my home. I had gone through the struggle with him because I counseled him until he was ready to close. So unlike any of the other programs, what we're only really majorly concerned with what has happened to you within 24 months of your life. So if you've experienced let's say a repo 3 years ago, then, ethically, I say that maybe it's not correct, because as she mentioned about integrity, I understand that, but for some reason, NACA has this awesome product where they're lending on, it's per se character lending rather than your credit. Character is a combination of a lot of things. How much time you've had on your job, how you've paid your utilities, your cable, your daycare, those type things. So my advice to all of you, if you've never paid those things that you don't think that will be required in obtaining a loan, pay those on time.
Will you all work with me even if I've got delinquent child support for the entire lifetime of my children?
Well, again, that's where that 12-month come in. So, if you've had it previously, and then moving forward, you've kept those payments on time for a minimum of 12 months, then I am ready to go. 12 months and a day.
Call you Ken, folks.
Can I add one other thing? One other thing that I see quite a bit of on credit reports are where people co-sign on different things. Cell phones, for whatever reason, seem to be the worst. Parents co-signing for their children. Keep in mind, co is equal. So if it's their debt, it's your debt as well. And so if it's a collection or whatever on the credit report, it goes down on both credit reports. So be mindful of that when you go to sign for different things. Me personally, I don't co-sign at all.
My son tells people when he was 13 years old, I told him, I ain't buying you no car. I ain't co-signing for you no car. When you get a car, you save your money and buy it. And he saved his money and bought it.
Wow. What's your next question?
Now, let me summarize where we were on that advice for credit issues. Seems like the number one thing is you've got to go to the right place to get help. The credible places to get help is an organization that's recognized like a NACA, a HUD certified housing counseling agency, someone who can be vouched for by third parties in the community that this is where you go to get objective, real help to get from where you are to where you need to go. Chances are, if there is payment involved, you're not at the right place. If there's some upfront money involved, you're probably not at the right place. Chances are, if it's a slick radio ad, you're probably not in the right place. So take your time, get to the right agencies that can get you on the right track to recovery, because we know there are events in people's lives that, regardless of your character, regardless of your prior behavior, they just throw you for a loop. Unemployment, death of a spouse, divorce, illness, death of a parent. We know what that list is when we see it. Oh, because you can see it on the credit report. You can look at a person's history and it was just perfect. And all of a sudden in 2004, something, whoa, a lot of out of character behavior. And then in 2009, you see them pick it back up. That's an event in someone's life. That's different from Bubba, Bobo, or Pepe, depending on your culture. The person who ain't never done right, bad grammar. Okay, that will show on the credit report as got it, no payments, got it, no payments, got it, no payments. And when you see them, they'll always have an explanation that starts with what had happened was. Okay, so that's a behavioral turnaround. But for people who are recovering from events, it's different. There is real help. We know that in a 2 to 3 year horizon, you can be back to a different place, have your life back, and be on track. So now, moving along with that, we've answered some of the questions inherently. Minimum income allowed. Now, we talked about the fact that the income is relative to your debts, okay? And that is what determines what you can buy. So it's a combination of things. Your income, your existing debts that you have right now, and that'll determine how much you're trying to buy. When people say pre-approved, it's that formula. Anything you want to add to that one?
He's asking me questions. He's taking me off my game.
Yeah, I wasn't going to be the elementary school teacher and say, stop disturbing your neighbor. The pre-approval. The income allowed. NACA may have a different picture of income allowances.
Do you all you all just maybe speak with someone over the phone and give them a pre-approval based on you instantly running the credit versus you do?
Yes.
Okay. Well, with NACA, unlike NACA, we don't pre-qualify you. We take you through the entire process before you receive what's called a qualification letter. Once you receive that letter, 99% of those individuals have closed. The only 1% are those individuals that have basically, let me say it, lied on the application, did not provide the correct information. Those are the only individuals that did not follow through. The reason we do that is because a lot of individual situations change.
Parenthetically pause, please. Now, lying on the application, and this happens on people's jobs, omission is a lie. Okay, leaving it off is a lie. And you put somebody through weeks of work when you knew what was on there, like it just popped up somewhere along the process, then your loan officer is probably not going to be as much your friend as if you had been honest with them. Okay, so this is your advocate in getting through the process. Please, sins of omission are the worst kind. All right?
And he's absolutely correct. I always want every individual to feel as if you're my family member. I always say after the workshops, you know what, we're now in a relationship. And what we do in a relationship, we're open, we're honest, and caring, and those type things. So I need you to provide all of the information to me. I mean, I still have members since I've been there that would even call me, hey, Miss Cherie, should I get my tooth pulled this week? Or, what should I do with my money? Should I do this? It's funny because when I first got there, I would laugh, and then I thought about it. I said, they really don't understand, and they trust me to lead them in the right direction. So I have to provide that information to say, you know what? If my tooth is hurting, I wouldn't have picked up the phone to call anybody. But because you took the initiative to call me, let me tell you what you should do. Let's try to find you a dentist that wouldn't charge you as much, you know what I mean, so that you can stay on track. Because a lot of individuals are so concerned, and as she mentioned, they're go-getters. They really want, by any means, they want this to happen. So I think that that's very, very important here.
Okay. We were talking about income, and per se, there really is no minimum income. It really depends on the debt to income ratio and the type of house you're buying, and that's kind of where I kind of got a little sidebar, because I was wondering, whether they had a minimum loan amount. We don't have a minimum loan amount either, but generally speaking, it's very hard to get a mortgage under $50,000. Because you run into too many different obstacles in terms of the costs that are associated with it, and it gets really complicated. But it's generally, if someone comes into me with wanting a $20,000 mortgage, my first thought is, well, what does a $20,000 house look like? Chances are they're not going to pass the appraisal. I mean, that's typically, those type of houses are typically investor type properties. People with cash on reserve goes in, and it's pretty much a cash transaction. So it's very hard to get a mortgage product on that low of a loan amount. So in answer to the question, do we have income requirements? Typically no. It just depends on the debt and the overall picture.
Well, you got to make money in order to get approved for the home, and we're going to go based on your income and your debt to income to see what you can afford. The other thing is, what we're starting to see is you got to be careful with those frequent job changes. We don't mind you changing jobs, but we want to see that every time you change is for a good reason. The underwriter wants to see that as well. And a good reason for changing jobs is what, guys? More income. And we won't hold that against you. So you just got to be careful, because sometimes we get angry, we don't like the people we work with, and we're going to change jobs. So you got to be careful, because we're looking for stability. And I got a customer I'm doing a loan for, no credit scores at all. He qualifies for a loan. It's called non-traditional credit. I got his JEA bill. He's been with JEA for 7 years and was late 0 times. He's been on his job for 10 plus years. His rent, he's been in the same place he's been renting for about 7 years, never late on his rent. But he has not established any credit, because he decides he doesn't want credit score, he doesn't want credit, he doesn't want credit cards.
Well, I thought I had to have some debt to get a mortgage.
What was that?
I thought I had to have some debt to get a mortgage.
Well, he has debt. He got JEA bill, he got his phone bill, he got his cable bill, but just so happened those bills do not report on the credit. But it tells you how a person pays he or her bill. Now, you know it's real hard not to be late with JEA for 7 years. That's commendable.
But that's a real important point about the non-traditional credit and the no credit report, because there's a real common misconception that you have to have debt, have credit on your credit report to get a mortgage. So somebody, Aunt Susie or somebody, told them to go out and borrow some money so they can have some credit on their credit report. As she stated, that is very much incorrect. In fact, especially with an FHA mortgage, the loan officer can put together the documentation that describes you as a low risk, because you are not a credit seeker. You are a pay your stuff every month person. Right. Okay? And they'd much rather present a pay stuff every month person than explain your debt to income ratio, because you got a Victoria's Secrets bill, you got a jewelry store bill. You'll be surprised how many Victoria's Secrets you see on credit reports. I don't know what they're selling in Victoria's Secrets that requires you to go in debt for it. I don't even want to know, but you'd be surprised what you see on people's credit reports that gets in the way of them getting what they say is really important to them.
And you know, the one thing that you talked about that is so important, and I tell everybody when they're buying a home, and I know because this is a ritual for me, and I let them know that they are mine until we close this loan. I tell them I don't care where you are, if you're in the mall, I don't care where you are. And I do a lot of physician loans, I do a lot of doctor loans, I do a lot of first-time home buyer loans. I even tell my physicians, until we close this loan, if you are somewhere and you are about to do something that you are not sure whether that is going to affect this process, you got my cell phone. Text me or call me. I don't care if it's 9 o'clock at night. Because nothing is worse when you get close to that finish line and it's something you did to cause the loan that was conditionally approved to not get approved than something that the lenders did.
Oh boy, it's a very real story, and I wrote a book on credit, and it's actually one of the stories in the book that I was working on a loan, and it was a VA loan. It was a very difficult loan. It was very tight, very tight. In fact, the lender didn't want to do the loan, and with VA, you can actually go appeal to VA and get VA to approve the loan. Okay, that's a lot of work to get somebody approved. But, you know, you're working with them, and like you say, you're feeling it, and, you know, we're going to make this happen. Mm-hmm. And, of course, they got discouraged, and somewhere along the line between there and doing all of that, they went out and bought a Mercury Mountaineer, a big old $500 a month payment. And we got ready to close, and I was like, I was walking on air. We got this thing done. Right. Pulled the credit report right before go to close, and it's Mountaineer. What? So I called him. Yeah, man, we got discouraged. We didn't think it was going to happen, and so we just went and bought ourselves something. Well, I hope you're going to live in it, because you just killed this housing transaction that we've been working so diligently on for the last 3 months. Real life, people actually do it. So as you're going through the process, and they say, don't do nothing until you call me.
Right.
That's why that dentist appointment didn't happen without calling, because that person was listening. They were serious. They took it literally. Take it quite literally. Wow. Don't do anything until you unpack the truck and put your bed in the bedroom.
Right. And you know what? And let me tell you this. There are some things that you go get loans that are not reported to the credit bureau. I'm going to give you one. A lot of those auto dealerships, buy here, pay here, where they don't report to the credit bureau. Guys, there is a system out there called LexisNexis. If you know an attorney, ask them. If you know an underwriter, ask them. They can put your name in that system and find out just about if you got a property in Arizona that you didn't tell us about. This is a system that a lot of the legal establishments subscribe to, and it's a whole lot of data. Like when people getting divorced and the husband's trying to hide money somewhere, LexisNexis. Just remember that, and they can find out. I had a lady I was doing a loan for, and she had a property that she financed through, and it was a hard money lender. Wasn't reported anywhere. Sent the loan in. I'm writing down all her properties she owns. She didn't tell me about this property because she thinking she went through this hard money lender. It's not on COJ.net. It's not in public records. It's not anywhere. I get an email from the underwriter. Here's a property she's owned with this mortgage. LexisNexis.
You can run, but you can't hide. Stay right there. You mentioned spouses. One of the questions that we have, and this is a good one. This will start some discussion. We got 2 spouses with 2 different credit reports. One's got 800 score. One's got a significantly different score. And my question is, since we got all this income, we obviously can make the payment. Can we use the better score and just work that thing?
Absolutely not. In order for you to be on the loan, and include the credit, you got to have also the minimum credit score. But let me tell you where it does work. It's a yes and no answer. So we're going to use your spouse income. We can't use yours because you don't meet the minimum credit scores. But what we can use that spouse for that's not on the loan, we can put in what is called compensating factors. So I'm putting your loan in. I've gotten loans I got loans approved with FHA at 52% debt to income ratio.
Normally, 41% is the limit, so
Right.
listen up.
And this is the thing. So what I'm writing up these notes to the underwriter saying, this is why I think you should approve this loan. He has a spouse. I'm sending the spouse's pay stubs in. She makes $65,000 a year. They've been married for 10 years. They got 3 children. So although he's at 52% debt to income ratio, and I'm getting approval through AUS, it's an automatic system, this is why I think you should approve the loan. So these are the compensating factors. And I'm showing her credit report. She doesn't really have a whole lot of debt. I'm showing her income. She has a lot of income, so he has this other we call residual income coming in. So those are the things, we can't use them on the actual loan, but we can use those things for compensating factors.
Same here.
Yeah.
Okay.
We
Hey, NACA's going along. Hey.
You know what?
Okay, we found the common ground. Okay. There may be some divergence on the next question. Affordability. For the mortgage process, obviously, there's a specific set of numbers or ratios that defines approval. But what you can qualify for and what's considered affordable may not be the same number. So, paternal lender, tell me what I can afford and how you determine that.
I typically look at, like I said, around 40%, because just as it was indicated earlier, there are a lot of things
Excuse me. What is 40%?
40% debt to income ratio. We're looking at your gross income monthly versus your minimum monthly payments, including the new housing payment, and I'm looking at like a ratio of about 40%. Okay?
So translation
Based on your debts on the credit report.
Translation to the way we talk is that you got, of your income that you bring in, that you make, you're allowed to have 40% of it obligated for debts. Well, I got 100% of my income. The things that aren't included in that are things like she mentioned earlier: your child care, your gasoline, your taxes, your insurance, your groceries. Okay, so that 40% says, because again, back to the definition of affordability, given all these other things you pay, taxes, insurance, et cetera, if your housing is more than 40% of your income, it's probably too much, is what that translates into.
Exactly. It's going to be tight, or it potentially could be tight. And from a lender's perspective, there's a higher likelihood of default, the higher it gets. So, and keep in mind that even though you may be at 40%, it may not be affordable to you because only you know what feels good to you. You're the one that has to make that payment. So I would say 40% is where I kind of start with, and kind of, just rule of thumb to kind of have people looking at. But then I try to get them, to a realistic number in terms of what they feel comfortable paying.
Well, the other part of that, though, is the sticker shock. If your cost of housing is now 15% of your income and you're getting ready to go to 40%, chances are we might need to reevaluate that decision.
Now, my debt to income is 40%. I will not exceed 40%. So it's mandatory 40%. Where you mentioned if it's a result of a payment shock is what I call it. If, say for instance, if you're currently paying $600 in rent, you desire, and 40% will allow a $1,000 a month payment. And what he says, that is going to be a shock to most individuals. But with our program, what we do is we prepare you for that housing payment. If you say, Cherie, I qualify for $1,000, I can do it, and then how are you going to prove to me that you can do it? The way you're going to do that is you're going to save in a savings account $400 a month, without any withdrawals, for 3 months minimum, and until you close on the home. If you've never paid rent before, then I want to see 6 months. I use the analogy that I cannot pay Chase or give Chase my monthly mortgage payment and then call them and say, hey, you know what, I'm at the Coach outlet, I need about $300 of those dollars back and I'll pay you at the end of the month. I can't do that because once I submit that mortgage payment, it's done, out of sight, out of mind. So that's what I try to prepare my members to do, is to save those additional funds every month without making withdrawals. If you make a withdrawal, then I need to wait 3 months. I don't like to see NSFs, because if I see that you're saving those funds and then now your checking account is affected by it, then as he said, I need to call you back in and we need to reevaluate this. Maybe $1,000 isn't your payment. Maybe we need to reduce that. But that's my way of determining if really you're able, to make that higher payment.
Now, and I'm very, very consistent with that, because the only way you can afford it is if you can show you can afford it. And the only way to afford it is to build it in and live with it and not have problems. If you got to go back and dip back in, it's kind of like the definition of savings that we have. Definition of savings is not we put it in on the first and we go back and get it back out on the third. Okay, definition of savings is when another first rolls around, it's still there, and we're putting some more with it. And another first rolls around, that's savings. And that's how you demonstrate that I can afford this level of expenditure in my budget. So absolutely, we agree with that. Now, on affordability, I will depart from the 40%, because I would submit to you that for a first-time home buyer, unless your cost of housing is already a higher percentage of your income, you probably don't want 40% of your income to be devoted to housing. You don't want to be house poor. Frequently, as a first-time home buyer, you're at a stage in your life where you got children, you have acquisitions, you have stuff to pay for, you are not accustomed to maintenance and stuff breaking on houses, and so you have no landlord. So we need to have that built into your budget. So when we start loading the budget down, we like to be conservative, and we don't like to see because that other 10%, let's build in a 10% savings so that we can do something for your family going forward permanently, so that you will not be house poor, so that also if you run into a period of difficulty, we have some cushion here. And we know that in the counseling process, one of the reasons why you want to go to class is we help make sure that you have that kind of budgetary stability, because we like she said, we don't want you to just get into a house. We want you to be able to stay in the house, afford it, and be a productive part of the society. We can show, hey, they did it, and we can bring you back and you can tell folks that it works. All right, we actually have gone over an hour. Nobody's asleep, and we really don't want to keep you all day. Can we thank our panel of lenders? Okay, and we've committed to do this. Y'all think we should do more of this? Okay. We've committed to do this the last Saturday in July. We're going to do this again, and so you can go to the website. The web address you can stay posted on is www.jackshousing.org. Okay, easy to remember, jackshousing.org. What's that address? I'm hard of hearing. What's that address? When you want to get the latest updates, where you want to go? Okay, with that, that's really what we planned on today. If we're still here, we plan to be here till 2. We like to not hold people past the appointed time, and so we'll take the rest of the time to mingle, to get questions asked, to prepare for follow-up. And for those of you who need to see me for the home buyer education follow-up, please do so. Are there any questions that we have not answered that we have a burning desire to make sure we all know the answers to today? Yes, sir.
If you have a payment that's due to be paid off prior to a loan,
Okay.
what's the time limit that you have? Say if it's within 12 months of paying off your car, does that count again? Very important question.
Very good question.
Let me summarize the question in case everyone didn't hear. You're applying and you've got certain debts that are going to go into your debt ratio, okay? But I got this car payment, but I only got 3 payments on it. And I got this other payment that I only got 8 payments left on it. How is that treated for the process?
We can disregard that debt as long as it's within 10 months of being paid off.
But at least we could never exclude it.
One lender says we exclude it at 10 months, and that's one of those add-on, layer-on. The investor who actually provides the money that goes to the bank that comes to you has a certain set of provisos, but the lender has some responsibility to be giving that money out judiciously, and they say, well, we're going to take the reins on a few things because they know they create risk. I don't care what Regions is doing. I'm saying I'm going to add this because I don't want that risk.
Right. But I think I think it's across the board with lease agreements, because if you have a lease agreement and I don't care if you got one payment left on it, we still have to include that in your debt to income ratio, because what happens after the lease agreement is over? You got to get another car, right? But if you got 5 payments on the car that you bought outright, 5 payments, what happens to that vehicle? You get to keep it. And that's the reason for the 2. And I think it's important that I explain the difference, because I think when you do that, you guys will remember that.
Can I say one thing?
Yes.
We're actually the 10 months as well, but I think the only thing that we differ with, say for instance, if Mr. Jerry co-signed for his son an auto loan, and his son is actually making those payments? Same. Okay, same for you? Yeah. Okay, we just didn't mention that if your son is making...
As long as Jerry's son
can provide proof
that he's making the
payments,
it's coming out of his account.
That's right.
And proving that you're paying the loan is just like we talked to before. He's got to have those canceled checks from his account, from his account, to exclude it from my ratios. My advice, don't co-sign. That's just my advice and counsel. I can be rigid in some things. That's one of them. Okay. With that, we'll conclude this panel discussion, and we'll pick it up in the last Saturday in July, and we'll cover some topics that are important to people and keep our constituents informed. Thank you for your time and attention.